Welcome back to Financial Strategies with Andrew Adjemi in Connecticut and Daniel Adjemi in Colorado.
It is difficult for me to tell you how many times I've heard people talk about, well, I don't have enough money for retirement, or so I'm going to need to invest more aggressively so I can make more money. And this just boggles my mind because I said, wait a minute, you're a couple years away from retirement and you want to risk more, and you think you're going to make more money because of that. Well, if you risk more and you make more money, you know, it wouldn't be risky. It's not, you're not guaranteed to make more money just because you risk more. The risk versus reward scenario is an important scenario to look at. And that's why today we're talking about risky business, looking at risk. I'm Andrew Adjemi.
And I'm Daniel Adjemi, and you're listening to Financial Strategies. Our subject today is risky business, and what we are trying to do is educate people on different types of risks they may not realize are out there, as well as help people to be able to ask the questions to whoever is helping them manage their money, if that's themselves, if that's their advisor, if that's their neighbor down the street. Ask these questions, and if you don't get the right answers or they don't know, then you need to rethink the strategy, because you cannot take on risks that you do not realize you're taking on. That is how you blow up, right? That's what we use in the industry. When an advisor blows up, they make a mistake, they're done, and they could go become a garbage man, or they could go do something more suited to their skill set. But if you blow up as an investor, that's your money. You're done. What are you going to do?
Right. Going to run out of money. And that's what the greatest fear that retirees have, is running out of money before they run out of life. And we're glad to be able to talk with you today. And this is a crazy thing, Daniel. They say, "Oh, I got to take more risk so that, and then I need to make more money, so I'm going to take more risk." Like it equates, take more risk and you make more money. But no, I mean, if that were the case, it wouldn't be more risky, right? That'd be
Right.
kind of like guaranteed. You're guaranteed to make more money if you take more risk. No, you're not.
No, because people get that thing, that saying, more risk, more return.
Right,
And everybody throws that around. So they'll say that, right? They'll come in and they'll say,
right.
well, more risk, more return. But no, more risk may give you more upside potential, but it's potential. More risk means more risk, which means it could make you blow up. And permanent loss is impossible to recover from. So if you get
Right.
permanent loss from taking on that more risk, then you're even in a worse spot than you started.
Yeah, exactly. And like you said, it's potential gain. Take on more risk and you have potentially more gain than potentially more gain. But with that, you also have potentially more losses with that. And when you get close or in retirement, taking losses, it's not a lot of people who want to do that, because that's one of the greatest ways that people run out of money before they run out of life. And so, this it's important for people to be able to understand how much risk they're taking on. They need to ask good questions to be able to understand the definitions of the words that people are using regarding risk, so that they can get involved and be able to make smart choices, smart decisions. I mean, this is your money. So you need to be able to make choices, and you need to be educated in a way that you'll be able to do that. Like we say here at Adjemi Financial Strategies, an educated retiree is a happy and stress-free retiree, because they're able to make smart decisions easily and quickly because they've got the education to back that up.
Yeah, and I don't know if you mentioned it about sector risk.
No.
Um, that's another one. And the reason I bring that up is because when we're talking to people, the two things that I find typically have the most questions about is, one is inflation. And then the second, they don't articulate this way, but interest rate risks, right?
Right.
And the interest rate risk comes in into play, because if rates go up, what will that do to the stock market?
Make the stock market come down.
And the reason for that is because these tech companies have become larger and larger and larger. And what you buy when you're buying a stock is you're buying the future earning potentials of that company. And
Okay.
so when rates are low, what happens is those future earnings become more and more valuable. If you earn negative rates by having your money in the bank, or you can earn Apple's future earning potential out into the year 2050, that looks attractive if you know you're going to lose 2% in the bank,
Right.
right?
Right.
But if rates went back to a normal level, um, that those future cash flows in 2050 would not look very attractive,
That's right.
right? And so that compresses the multiple on Apple stock and brings it down. And so
Right.
sector risk, why I say that is because the technology sector is insane right now.
Right.
How big of a portion of the markets it makes up. So for gross domestic product, so what it adds to the country's value, right? If the country was a company, gross domestic product is how much the country is earning.
Right. Right.
And it's about 6%. So it adds to GDP about 6%. These are at the end of 2020 numbers.
Okay.
As far as employment goes, what percentage of the pie of jobs it represents is 2%. And then what percentage of the S&P 500 it represents
Yeah.
is 38%.
Wow.
So what does that tell you? You love Apple, so you have
Yeah.
Apple in your portfolio,
Right.
and you buy this actively managed tech fund, and you own the S&P.
You have Apple in all of them.
Are you
Yep.
diversified, or are you in one sector?
Nope. One sector. Terrible. Yeah.
And that's what you have to watch out for as far as what you're talking about, more risk, more return. People keep saying, well, the tech companies, they don't really have risk, so I'm going to put it all into those. But that's flipping back to that bond you kept talking about, right?
Right.
At the beginning, when you were paying cheap money for it, you only had upside potential, and it was a
Right.
strong balance sheet.
Yeah.
But then once it came up
Good job.
over par, you knew when it came due, you were going to lose some of the money. You're still going to get the dividends, but you were going to lose some of the money because they were going to buy it back from you at a lower price.
Right.
And the fundamentals didn't look as good. They didn't look bad, but they didn't look as good. So
Yeah.
if you don't have upside anymore, what are you doing owning it?
Right. Exactly. And Daniel, it's real interesting what you're talking about the difference, the correlation between interest rates and the stock market as well. And I don't know if the people in our listening audience realize this, but right now the Dow is somewhere around $34,000. 34,000 is where it is approximately. And people may not realize this. 40 years ago, in 1980, the Dow was 700. 700. Crazy, right? But what were interest rates in 1980? Double digit. The stock market was not doing well because interest rates were 18%. I didn't know. I was in the ministry at that point. I didn't know anything about investing, but I did have some money, and it's just a no brainer to me. I put it in a money market account making 18% rather than in the stock market that was making less than that at that point in time. And so it was just a crazy thing. So that's a great example of that correlation and of that risk reward kind of thing. Is it was a much higher risk being in the stock market back then, but the reward wasn't as great, at least on the short term. Over the long term, as history played out, the next 20 years, the market just basically went straight up. But nevertheless, that's a great example from that angle. That's good. Thank you for sharing that.
Yeah, and so as we're wrapping up, people would like to know, like, well, what do I do to protect myself, right?
Right.
And so you need to ask the right questions. You need to be able to ask. You need to talk about, like, how will rising rates affect me?
Right.
If the government puts on capital controls and they cap the rates so they can't rise to protect
Right.
markets from coming down, well, now what kind of moral hazards am I taking on? Am I just hoping that my stuff's going to continue to go up because the Federal Reserve is going to create free money? Um, if rates go negative, what kind of risks am I taking on? Um, Sector diversification. How much do I have in tech, and do I need to be diversified? And so companies that have pricing power, right? Like what we use the streaming companies because they know their fixed cost, right? They put
Right.
this much money into a company, and that's all they can lose.
Okay.
But if rates go up or inflation happens, then
They're
without
going to make
having
money.
any more outflows of cash, all their profits go up,
Nice.
right? Like not a little bit.
Yeah, a
Like if
lot.
you're paying, it's the opposite of everything you've been talking about, AAA. You've been talking
Yeah.
about how like cars, right? You could buy
Yeah.
it now and now it costs this much. All the
Right.
materials for that went up too. The car manufacturer isn't making any more money. They're just barely keeping up, except they're probably not even keeping up because they have to pay their employees more because we just raised the minimum wage and people need to make more money because everything's more expensive. But what if your expenditures were fixed?
Right.
but
Nice.
but
Thank you,
the
Steve.
pricing power went up exponentially when um rates rose or when we had inflation. That's the kind of things these streaming companies are some of the best markets, some of the best companies in the world. These are the things that you can do to start protecting your hard-earned money against devaluation of money, right?
Exactly. Wow. We could keep talking for a long time, but we have to come to a close for this edition of Financial Strategies with Andrew Daniel Adjemi, because people don't know what people don't know. We want to help them to understand that. So listen, we're giving away a book, Financial Insanity by David Scranton. Don't let or How to Keep Wall Street's Cancer from Spreading to Your Portfolio. And for the next 5 callers, and that's a free of charge. We do ask that we'll be able to have a 10-minute conversation with you after you read the book to get your ideas on that. And we have the paper, 7 Risks to Your Retirement. 7 Risks to Your Retirement. You can call now, talk with Megan at 800-725-7616. 800-725-7616. And until next week, folks, thanks so much for listening.